Welcome, friends, and good morning to you, all of you. In this edition of classes on the paper 2 Strategic Financial Management, I, C. Ashish Gupta, Deputy Director Board Studies, welcomes you all. Now, students, uh, this time we have come out with a hybrid mode where, along with the recorded lecture, we are also conducting live sessions also. So, students, now this session is live. After that, we shall upload the recorded lectures. You are requested to go through these lectures. After that, we shall have one live session with you. Accordingly, for each session, like for security valuation, first we shall upload the recorded lectures. Then the concerned faculty will take the live session where he or she will brief all about the previous sessions on that topic, and you are free to ask your queries in this session. Of course, in between, if you have any queries, we shall share email as well as phone number with you. You can contact us, but still, if you are want that concerned faculty should take up our query, so the possible this facility has also been provided to you. So, student, now I am just starting with you with a basic framework. What is exactly about our CS curriculum, CA paper SFM curriculum is this? Student, this paper is basically both numerical as well as theoretical. And many students saying good morning. This is Mansha, Panu, Namarta, and Shri Niti SS. Good morning, all you students. Welcome to you all. I welcome you all. Now, here in this paper, there are two numerical as well as theoretical question also. 80% coverage is of theoretical. 80% is numerical and 20% is theoretical. So, student, please note that with each question, since theory has been attached, so there is no possibility that you can drop out the theory in your preparation. You have to do it. Now, student, the benefit of doing the theory portion is that first, it gives you a conceptual clarity. It develops a conceptual clarity for you. Second is, sometimes even a practical numerical question you may not be in position to attempt in the examination, then theory question will help you to score the marks. Now, student, another important point is that this paper is basically the extension of the paper FM at intermediate level. There we discuss what is the basic about the financial management. Here we can say it is the application of strategic application of the concept of financial management. And more important, student, always remember, please go through the syllabus properly, because syllabus is a basic framework which is normally provided to the paper setters, and paper setters normally frame the questions within the preview of the syllabus. So it is always advisable to you, please go through the syllabus, because sometimes you will see that there may be one topic that has never come into your examination. This time the topic can come. It is a full of surprises for you. And next is importance. More important part, don't ignore any topic, because of course, like most of the time I have observed that students say, sir, my favorite topic is forex, foreign exchange risk management. My favorite topic is bond valuation. Of course, any topic can be your favorite, but please remember, no topic is unimportant. All topics are equally important, and you have to do all the topics, because sometimes what happens, because it is the whenever I will share in the last session, I will share with you the question paper. In the question paper, what happens? Each question contains 3 parts. 2 part numerical, 1 part is theory. Now, what happens? First part, the two parts of the numerical, rarely it happens that they are from the same topic. Normally, they are from the diverse topic. So, accordingly, if you skip any topic and one question you can, one part of the question you can attempt, the other part you have to will be left unattempted, and that ultimately will lead you a loss of the marks in your examination. So, student, please don't skip any topic. This is my sincere advice. Now, there are one important point. This is normally confusion among the students. Sir, is there any amendments are there in SFM? No, student, there are nothing like amendment like income tax or law and AS. However, there are some contemporary developments that take place. And my advice to you, you should be well aware of this, because even a paper setter can ask the questions from the contemporary development. For example, recently there is a collapse of SVB Bank. Now, this due to this SVB Bank, the all the Indian startups are shifting their money from SVB Bank to the Indian gift city. So this is very big news. Second, very good recent news, not recent, if we can say that it is somewhere around about 1.5 years ago. In from January 1 January 2022, the LIBOR has been seized. Now it is no more in use. There are different rates like SOFR, Sonia, Yester. So there are different rates, benchmark rates. Although in your study material, we are using the still LIBOR, but please remember it is just kind of a benchmark rate. This can be any possible rate. So these are some content, like there is another SPACs. About SPACs. SPACs means special purpose acquisition companies. These are contemporary topic. Another is a very good term recently have come into the picture with the Russia and Ukraine crisis. Special Vostro account has come into the picture, because now there are discussions are going on why the dollar should remain a reserve currency. The even rupee can also become a reserve currency. So that's why RBI has given the guidelines, and after this Ukraine crisis, now Russia, etc., Russia and other some countries are also opening their special rupee Vostro account, where the all settlement will be made in the rupee only. And next more important point, don't mug up the questions. Student, 1 minute, student. Yes, Namarta, yes, you are right. I have written this article in student newsletter in February 2022. I have written this article. Thank you, Namarta, for recognizing for this recognition. Now, more important point, this don't mug up any question, because recently in a 1 or 2 examination, it has been observed that in end of the each question there are some advisory portion. They want to test your knowledge. Okay, and more important, sometimes it has also been observed that the questions can be set in a reverse order. Okay, because very good example I give you now, where it was earlier used to be a question that you have to compute the yield on a 3 mutual fund, annual yield on them. Now it may be possible that you are provided with the annual yield of the 3 schemes, and you have been asked to compute the date, or you can say days of the investment. So this is a kind of a reverse working. So anything can be possible. So please don't mug up the question. Try to understand the concept. Questions can be of 100 types. Once the concept is clear to you, then you won't face any problem in the examination. Of course, sometime you may have good feeling if the question that you already referred and it comes into the examination, it gives you pleasure. But still, sometimes there may be some surprise element. But don't worry. At this moment, please apply your mind and attempt the question fully. Of course, you will be able to solve the question. Now, next question. Sometimes students say, sir, how we practice the practical questions? First time, whenever you attempt the practical question, you attempt each and every step, because it is very important. Sometimes, of course, sometimes you may say that, okay, sir, I can do this back of envelope calculation. Back of envelope calculation means just small calculations. You can say that I can solve it by using the back envelope calculation. But student, you have to do all the steps. You have to mention all the steps. Not it is means 2 into 2 you have to show equal to 4. But reasonable working, your answer should be supported by reasonable working notes, and almost should cover the important steps also. Because if you give the answer straight forward in a 1 or 2 line, of course, if the answer is in a 1 or 2 line, then you have no choice. But if it involves some working, then you should show how you have reached to a one answer. It is very important. So please do, first time you just do all the complete all the steps. Next time, of course, you will say, okay, I can skip 1 or 2 steps. And in the before just examination, of course, you will have just only calculation mode. Just you can scribbling type of thing. Mansha, I will I will take up your query. Don't worry. I just will take a query. Now, next very important point. Whenever you attempt the numerical question, so it is always remember, of course, you have in the up to the last, you have just do the scribbling work, but in examination, you have to attempt all, do the all the steps. Next, very important, attempt mock test paper in examination like conditions. Student, it is a very important for you. Whenever mock test comes out, normally I have observed that student normally go through there from the website. In the excitement, they normally goes through the website, and then they say, okay, I can do this much, this one. But my advice to you, please don't see the web. This is this mock test paper. If possible, I think there are some facilities where the nearby branches conduct the mock test paper. So it is better you go there and attempt the mock test paper in examination like condition, because this will enhance your speed. This will give you the accuracy with the speed in that with the examination like condition. And more important, when you go to the exam, when suppose if the facility is not available with you, where near any nearby branch, so then you should, what you should do, you should just take the printout of the examination, don't see it, and fix up your time, and just for the, like 15-minute reading time and 3 hours working, and just concentrate yourself, or you can say you can just sit in a room with a and keep your door locked and with one water bottle, and just attempt in an examination like condition. So certainly you will see what is the challenges you can face in the examination at before. So you will get a exposure what challenges I will face in the examination, and you will get ready for the same before the examination. Now, another important point, this paper is of second number. So it is very important that this paper should be gone very well, because it will give you the moral boosting for the other 2 papers. And another important point is refer any financial newspaper on a daily basis. Anyone, that is your choice, because it maybe depend upon the area where you are residing. So at least in each area, one financial newspapers are available. It can be Financial Express, it can be Business Line, be it Mint, be it Economic Times, Business Line. I think I'm just giving you the name. You can note down the name. It is Economic Times, Mint, Business Standard, Financial Express, and Business Line. These 5 newspapers are normally you can refer them. Personally speaking, I normally refer 3 papers. One is Economic Times, Mint, Business Standard, and Business Line. 4 newspapers I normally refer on a daily basis. Now, another very important student disclaimer is regarding this is, see, student, this session, there's a paper of strategic financial management contains normally some of a major portion of this subject is connected to the market, capital market, like portfolio management, derivatives. So please note that the even our sessions and even our all classes, etc., are mainly meant for your academic purpose. So please don't indulge yourself in any trading activity, because here our main purpose is to impart the education, nothing to promote for the doing the trading. So, and my advice to you, please, it is your study time. So don't your precious time, or don't waste your precious time in all these trading activities. Just go through, just refer the study material and just refer our classes and just do in the exam. So don't use it in your any trading, etc. And even recently, there was one good article in a Mint newspaper, that is, I think Mint was of 26th May. In a Mint article, it was clearly mentioned by the SEBI that because SEBI has come out with the guidelines for the brokers that whenever they will do any FO trading, this future and option trading with any client, so they will also convey the risk to the same client, because as per the SEBI, out of 9, out 10, 9 out of 10 clients incur normally losses in the future and option derivative transactions. So this is a recent article, 26th May, I think it was 26th May. In the Mint, it has been clearly mentioned. So when I referred to this article, I shocked that 9 out of 10 people have incurred the losses. So my advice to you, please don't indulge yourself in any trading activities like. Now, next is very important. Please refer the hosted material related to the paper SFM thoroughly. Don't skip any topic or don't skip any RTP, don't skip any mock test. Whatever way that is available, RTP suggested answer, please go through them thoroughly. And my last point here is this paper basically benchmark, as I discussed with you in the beginning, LIBOR, though LIBOR has been discontinued, but still we are using in the study material. And of course, with the passage of time, we can use another benchmark rate, but don't consider it wrong. We can use it as a benchmark rate. Now I'm just taking your queries, then I will come to you for your PPT. Now Manshas was saying, sir, at final level, I say expect knowledge from us. So does it mean that we should observe each and every happening in the real world, sir? As I also student, it does not. Of course, I say expect you from the knowledge, but it does not mean that my purpose of saying that you should be aware that what is going in the financial world. Okay, you are not expected to do any research, etc. You're not expected to do any research. You have to just a brief have any idea that what is going in the world. Because sometimes I have observed that when I ask 1 or 2 students, do you have any idea about the SVB failure? No, sir, we don't have any idea. Now, sometimes if I ask one student that one say, oh sir, I have any idea, it has failed like the Lehman Brothers have collapsed. So he was completely wrong. Why? Because the main reason for the failure of Lehman Brothers was the securitized debt, that is mortgage-backed MBS, mortgage-backed security. Whereas in case of SVB, the main reason of the failure was liability and asset and liability mismatch. It is a very good case study, because it is when we shall discuss the topic of interest rate risk management. Here it is very important, because what the SVB has done, they have say investor depositor has money with them for the long term, okay, and they have given the lend the money for the long term also. But what happens, because of this rate hike by the federal, the people have started withdrawing their money from the bank because they want to reinvest at a higher rate, and as a result there is a bank rush. So ultimately what happens, because whenever the bank has lent the money to any borrower, they may have parked the money for the long term. They cannot refund the money on one short notice. So that's why what happened, every depositor reached to the bank for the getting refund their money. So due to this asset liability mismatch, there is a failure. So my point is that my point here is that you just have any idea what is this. 1 minute. Next question is from the job Connie, sir, if in the simultaneous equation solving first writing and then there is x, so enough do I need to write between steps? No, I think if the simultaneous equations are there, you can just solving the equation, you can write that. Even if you can write that, it will suffice, but you have to present both equation. Please come safe to manage study and articleship. Namrata, it is up to you, because you have own strategy, and in my own time we used to manage both things. But my advice to you, if possible, you can, in your traveling time, you can carry the study material with you. Because I used to do, we in our time, what we used to do in our traveling time, we used to carry the study material with us, and we used to, our traveling time, we normally we used to use very precious, you can say, judiciously. That's helped us in achieving this uh, degree. So my advice to you, just use the traveling time. But otherwise, in article shape, I think it will also help you to develop the knowledge of some concepts, especially in case of a paper like elective paper risk management. I have seen that the student who are in the internal audit field, they normally say, "Sir, this paper is very easy for us because normally we deal with this paper in practically." Now, Namarta is again saying, "Okay, Manisha, we will see. We shall also try to conduct the session for the elective paper." Can you, Namarta is saying, can you tell how newspaper reading will help us? Of course, student, see what happens. Exam, of course, your studies are exam oriented, but sometimes if something you can ask in the examination, like what is LIBOR and why it has been seized. So, of course, your complete exam cannot be said that it will be a basic based on the contemporary development. But my advice to you, even a paper setter can ask only 5 marks question, or from the or the theoretical small question like 4 marks question from the your this on a contemporary development. So only that will help you, but it will also give you an idea how the market, or what is the basis, what is the basis of this all concepts. Like, if you go through the if you are well versed with the concept of Lehman, if you have any idea about Lehman Brothers crisis, then the concept of securitization will be clear to you. How the assets, bank receivables are pooled together, then they are divided and they are sold in the market. And when we talk about the SPAC means special purpose acquisition companies. So there, the concept of how the companies have been created just to merely acquire the company. So merger acquisition concept will be clear to you. So all these are related. Now here what happens? You have there was some Templeton crisis somewhere around, I think, 3 years back. So at that time, what happened? There were duration crisis, bond duration. Because what is bond duration? When the interest rate yield rises, so ultimately value of the bond falls. So duration, all this you give an idea how this all the concepts work. So basically, this will help you to all the concept, how this SFM concepts work. That will help you to understand. Namarta, in my inter FM is not good. So what strategy I should follow for this subject? Very good question, beta. And this is a question for all the students. Students, Namarta, I am very happy that you have asked this question, and this is because this is a common problem. Sometimes it has been observed that student at the an intermediate may not have been thorough with the FM concept. But my advice to you, again, bring out your study material. Only one concept you need to go through, and that concept is time value of money. Student, please go through this concept, time value of money. Other concepts, no problem, that you can develop under understanding, or at the most cost of capital, because the topic of security valuation is related to the cost of capital. That I will discuss with you when I will share my slide with you on the screen. So two topics, time value of money and cost of capital. At least two topics you just go through the same. And if possible, there is another concept, IRR, internal rate of return. Capital busting will be required. You can discuss, because it is ultimate IRR is based on the capital. So only this topic if are will be suffice for you. Still, if you have any problem, better you can contact me over the telephone. I will share my number with you, so don't hesitate to contact me. Now, student, I am sharing with you my slide. हाँ ये शेयर करेंगे शेयर ओके नाउ स्टूडेंट Now, this is the overview of the syllabus. To acquire the ability to apply financial management theories and techniques in the strategic decision making. Now, student, this is what you, if you see the line, to acquire the ability. Sorry. Acquire and apply financial management theories. So these theories you have studied at intermediate level, inter level. Now we are doing here in a context of strategic decision making. So this is a basic overview of, or you can say this is the objective of the syllabus, learning objective of the syllabus. Now first we start with the topic financial policy and corporate strategy. Now student, this is here you can say we have given an idea of how the strategic decision making works. The next topic, what is the relationship between financial policy and strategic management? Because finance is the lifeblood of any organization. Next is balancing financial versus goals versus sustainable growth. Sustainable growth means it is the growth that shall be continued, that shall be retained, that shall be remained. So it is very important to discuss because sometimes financial goals may be that you have to keep your capital debt equity ratio is into 4:60 ratio, something you have a financial goal. Now, if your growth is higher, then certainly you have to curtail your or retain your growth, because if the growth is higher, then of course your this structure can be this, it can be, there may be some change required because you will need some funding, and that from that there is a concept of external funding requirement that I will discuss in today's class. So all these have been covered here. Yes, Mansha, you are right. Now next topic beta comes risk management. Now student, risk management, this is a topic here, although there is a separate paper 6A elective paper for the same, but here our purpose of inserting this chapter is basically to give you an idea what are the main risks are faced by the any organization. Here we are covering more insistence we have given on the financial risk, because in a financial risk there are foreign exchange risk, then there is interest rate risk, and there is some, you can say, hedging also has been covered. So all this risk we have been discussed here. Liquidity risk also are there, and so mainly we have covered our in hedging, interest rate risk, forex risk, and even portfolio say security risk, investment risk is there. So that already has been covered in portfolio management. So all this we have covered here. Now next concept is value at risk. Now student, this is a very important concept. Value at risk means how much maximum loss you can bear. So that's why this concept is value at risk, means where, because normally what happens, you take the position, because position now the days are gone when all the amount is invested. Here, due to this foreign future and options, due to this future and options, what happens, you have to just give the margin money. Of course your exposure is wide. So by using this where you can came to know how much position I can take the market, so that my loss is not should exceed this much limit. All this has been you can say that confidence level like 95% confidence level. So all concepts have been discussed here. I think there is one movie on this concept based, margin call. This I think there is one movie, I have seen this movie. In this movie, I think there a concept of where has been used. So I remember that because here in this there, because the bank or I think investment banker have taken some position and they are very exposed to very huge loss. Now next is our evaluation of appropriate method for the identification and management of financial risk. Here we are just giving the briefing, what strategies we shall follow. Of course, a complete description are covered in the later part of the your study material. Mansha, no, sustainable growth rate is not linked with the ESG framework. It is completely different. Sustainable growth rate means, of course, the word is like sustainable. Sustainable means better that will be continued, that will be remained. Of course, ESG framework is totally different. ESG means environment, social, and governance. So here, S means, of course, it is relating to sustainability. Sustainability, we can say it is something relating to sustainable BSR, SR reporting. Okay, na? So sustainability reporting, so it is relating to ESG, but here sustainable growth means organization's growth perspective. Now, next topic is fundamental analysis. Here we can cover topic is security analysis. Here we shall cover fundamental analysis. It is also called EIC analysis or CIE, both way, because it is top-down approach and it is bottom approach. So in this, what happens? EIC means first we carry out the economy analysis, then we do the industry analysis, then we carry out the company analysis. I always quote the concept of BRICS because in 2007, this concept has come into the picture. At this time, the Brazil, Russia, India, China, and South Africa, these 5 economies were booming, and all worldwide investors were interested in investing the money. Now, for example, if I say there any country, any investment banker choose so I want to invest in India. So this is we will carry out the economy analysis because out of 5 economies he choose the India. Next, in India there may be many industries like IT industry, cement industry, cheese industry, real estate, and automobile, and numbers of our industries are there. Now here they will have to make a choice in which industry we should invest the money. Pharmaceutical also in another important aspect. Now in a COVID time, the pharmaceutical companies was on a peak. Okay, so in a good time, the IT company was on a peak. When the economy was very growing, so automobile industry was also on a very higher side. So now they will decide in which industry we have to invest the money. Suppose they choose the industry like IT industry. Now in IT industry, there are different company, Infi, that was earlier Infosys, TCS, Wipro. Now here they will say, okay, we shall go for the TCS. So this is where they carry out the analysis. Yes, Mansha. Now, next concept comes the technical analysis. Now, student, while the fundamental analysis is a long-term analysis, technical analysis is, on the contrary, is a short-term analysis. In a short-term analysis, what happens? In a short-term analysis, we don't, in a fundamental analysis, our horizon may be for the more than 1 year or 2 years. In a fundamental analysis, our time horizon is quite long. In technical analysis, our horizon is short term. Short term means normally we normally prefer the investment only for the short term because we are not concerned with whether the company is making the loss, because in a fundamental analysis we are concerned whether because we thoroughly study the balance sheet, what is the cash flow statement, everything we go for the same. In a technical analysis, what we do, we just carry out, maybe the company may be in the loss, but at this moment the company share is flourishing. the company's share is going on a higher side. So it may be possible that we may buy the share and sell the share very quickly to book the profit. So all these are conducted through the technical analysis. They are normally also called chart techniques, because you will see that in the lectures of the technical analysis, there are some levels are there, because from this you can say that the share normally does not go. This can be, it is upper limit, this is lower limit. So you can see that the right position will be to buy at this moment and sell at this moment. So by analyzing the previous trend, you can say that this particular company, say X Limited share, never does not go below this price. Of course, you can buy at the same. And when it reaches there, you can say the price of the share never goes above this resistance level and support level, like this. These all terms have been used in your chapters also. So you can say that, okay, it is a support level, it is a resistance level, so I can sell at this level. So this can also be this. So all these strategies have been covered here. So this is called your technical analysis. And in this, so there are, of course, student, technical analysis is very wide. But here for your, we have covered only very small techniques, and we have given you only brief about the same. So normally, theoretical questions, or even there are 1 or 2 questions on the technical analysis where the efficiency market hypothesis have been tested. Now there is another concept here that has been covered. I want to cover it now. I recall it. Efficient market hypothesis, EMH, has also been covered here. What is EMH? EMH means how the market reacts to the any news. Of course, there are 3 forms. One is your weak form, weak, strong, semi-strong. So all these things have been covered here. You will study when when you will refer the study material, and you will go through our lectures. So don't worry, student. Everything is there in our here. We shall cover exhaustively. Now, next thing comes security valuation. Now, student, once we have carried out the security analysis, next thing comes security valuation, because it determines how much price we have to pay for a justified price for what we have to pay for any particular security. In this context, I will like to say that, student, it is I was in the beginning, I was taking the query. So basically, this topic is related to your cost of capital at intermediate level. Now, when we have taken the concept of intermediate level, normally say KE we have to determine. Okay, we have been provided with dividend. Okay, price is there, plus growth rate is there. So all things we have been provided, and we have to compute this. Now, when we will call security valuation, we can say how much price is justified. In this case, what happens? We shall provide with this figure. We shall provide with this figure. We shall provide with this figure, because this is the expected return of any equity shareholder, any investor. We shall be provided with the same. Then this will be determinable. How we shall have to require the determine. So accordingly, our price comes justified price D1 upon KE minus G. So ultimately, if you can say, it is the interchanging of the terms that we have covered our intermediate level. Similarly, if in case of a debt, debenture, in a debenture, normally, if you recall that we normally provided with the YTM. Okay, we are normally provided with the YTM, and from YTM we normally in here sorry, my mistake. Here we have to compute the YTM, because we are provided with the price of the bond. But here in this security valuation, we have to determine the intrinsic value of the bond. What is the justified price of the bond? Because we are provided with the YTM. We are provided with the YTM, required YTM, and with the dividend, our interest inflows and the cash flow at the maturity, we are supposed to calculate the intrinsic. What is the justified price? So this has been covered in here concept. and of course this theory equation, preference share, and devices. So all these concepts have been covered here. There is one more concept that is bond refunding decision is there, but here although we have covered in the study material in the bond refunding here, but my view is that normally it is a kind of a strategic financial management decision. So you will see in our further recorded lectures, I have covered there in our bond refunding decision. Then next topic comes better portfolio management. Now portfolio management, how we define the portfolio? Portfolio means once we have carried out the analysis, you see the sequence of the chapters. Once we have done the analysis, then we have identified the securities, then we have valued the securities. Now it comes the investment. So when we talk about the portfolio management is concept based on that instead of in famous idiom that don't put all eggs in one basket. So this is an important concept because idiom, because if it is better if you divert the, because suppose if you put all the eggs in a one basket and that basket falls down, all the eggs will be broken. Instead of that, you can divert these eggs in a different basket so that even if the one basket falls, other eggs remain the same. Similar concept is based on the portfolio. Don't invest your money in one security, one investment avenues. You can divert it because it is based on the concept that there is a, because here the concept come of coefficient of correlation. If the securities are negatively related, so what will happen if the one security return is falling, the other security return may be rising, so it will set off each other. So this concept has been covered here, portfolio management. Here the different portfolio analysis, portfolio selection, and here the modern theory. This is based on Markowitz theory has been covered here. Efficient frontier. Then capital market theory, because it is based on this concept. Portfolio revision. Once you have invested the money, does not mean that it will yield the money return to you for the whole life. You have to see that if it is not working, then you have to revise the same. Then there is a concept of portfolio valuation, Jensen alpha, Sharpe ratio, Tranier ratio, all has been covered here. Asset allocation, strategic, tactical, all has been covered here. Fixed income portfolio, it is very important, better. Fixed income portfolio means, now normally when we talk about the investment, normally equity share comes into our mind. But now time has changed and bonds have also become a very important investment avenues. And even the government of India are also trying to boost up this market, because presently the corporate bond market is not that vibrant that it should be. So there are efforts are going that we should make this market vibrant, so that investors not only concentrate on the equity, they also go for the investing in the corporate bonds. Because presently right now the bonds are mainly invested by in the bond market. The money invested is money by the financial institutions or the high net worth individuals. So here there are strategies has been covered. How will you handle this fixed income portfolio? We can say we can also create an income of portfolio of the fixed income securities also. Then risk analysis of the investment in the distressed security. What is a distressed security? Normally distressed security means that securities that portfolio means, sir. Okay, Namarta, I just tell you. Beta, portfolio means when we combine the various types of investment. Say, if I say you have, say, 1 lakh rupees with you, and if you go to the market and buy the share of Reliance, all the money. So this is not the portfolio. But if you go to the market and invest, say, 50,000 in a Reliance, 25,000 in your Nifty, 25,000 in your Infosys and Infi, and 25,000 say in any automobile sector company, Tata Motors, etc. So this will be a kind of a portfolio, or you have acquire some banking share also. So this will be called portfolio. So portfolio means the combination of the various securities. Even it can be investment. Like suppose if you have 1 crore of rupees, so you plan that I will invest the complete money in the market. So it will not be a kind of a portfolio. But if you divert the money, say you divert 10 lakh in gold, then 20 lakh in your share market, and for 70 lakh you estate in the invest the real estate. So it is a kind of a portfolio diversion. In real life, how can we invest in the corporate bonds, sir? Normally, student, in a corporate bond, what happens? Your question is very correct. Of course, you can acquire the bonds of the company because once they have come out with the issues. But problem is that since, as I told you, the liquidity problem is in the bond market is there, because suppose if you acquire the share of any company at the IPO or FPO, and even if you acquire the share from the market, normally you can, at the time of requirement, you can sell the same, because there are another buyer also. For each market, there should be buyer and seller. This is a precondition. In case of a bond, normally what happens? Buyers are not available, and if they are available, they normally deal with a huge quantity. Of course, efforts are going that the government are trying that we should develop the market. So at the time of investment, sometime company may come out with the, you can say it is kind of a non-convertible NCD. This NCD is also example of your bond. So, but always remember that these are normally unsecured instruments. So these all risk factors you should take care also. So I'm not, that's why I'm not discussing here what you should do for the investment point of view, because I disclaimer in the beginning that these are for your understanding purpose, or so don't, I am not I encourage you to invest anytime. Of course, for the knowledge purpose, bond is not that much, market is not that much vibrant. So normally investor, if they want to acquire, they can go for the direct subscription, and I think there are 1 or 2 platform maybe there. I'm not aware of that. Distress means, yes, I sorry, my distress means I was discussing it. Distress security means the investment in the shares whose companies are in a distress position. So normally what happens? There is a concept of credit rating. And normally say there is a AAA rating. It is a good kind of a rating, because it the credit rating knows, companies knows that this company will refund their all the investments, etc. But sometimes what happens, the credit rating of any bonds of any company may come to say A or minus A, something like that. So it indicates that it may be possible that the company may not be in a position to refund the money. So in that case, what happens? Another company can acquire the share of, because in the hope that the company will be recovered soon, and ultimately their prices will, their shares or their bonds will be go up. Alternative investment strategy in context of portfolio management. In this case, what happens? There are some alternatives also, like hedge funds, alternative investment funds. So there are some different venues has also been covered very briefly. Not in even gold, we have to some extent we have covered in the study material. Namarta survey, yes, better diversion of risk. Now next comes the securitization. Now in the securitization, beta, what happens? This is, you can say, also called the off-balance sheet or off-balance sheet financing also. In this case, what happens? Any company may have a good amount of receivables. Okay, but they are not liquid. They want to, that they need the money, so they are not liquid. So what they do? They pool all the resources, and they create a special purpose vehicle which sell these securities to the different investors. So this is called securitization. Now in this securitization whole process, there is a situation to everyone, a win-win situation to everyone. The sponsor originator get the money back. Okay, of course, what happens now? What happens? Say these are the debtors, these are the receivable company. And now what happens? This money comes, whatever the money comes to, if the money, say, if the receivables are returned back, I just tell you the procedure. It is a quite time consuming. Okay. I'm just briefly, I'm telling you, just not. Runa, I'm just giving you a very small idea here. Don't worry. Now here what happens, better say there is a company X Limited. They have many receivables. What happens? They pull together and they transfer it to special purpose vehicle. Now the special purpose vehicle issue the security against this, you can say receivable in the market. So what happens? Whatever the interest is coming to X Limited, it is transferred to SPV, and SPV transferred this money to these investors. Now, when this money is receivable money is returned, they return the money, they pay back the money. So ultimately, SPV refund the money, say transfer the money to these investors, and you can say destroy the securities. So it is a kind of a where what happens, benefit for the X Limited is that the illiquid assets become the liquid by transferring the money to the transferring this receivable to SPV, because SPV will get the money from investor, and investor will, this money will be ultimately come to X Limited. SPV work as intermediate. Yes, better. It normally works as an intermediate because originator is different. So all these concepts have been discussed in the topic on the securitization. Next comes the concept of mutual fund. Student, mutual fund concept is basically, you can say, it is a kind of a pooling investment. Normally, I will give a very good example. I think if I'm not corrected with the market, but I remember that, say, Reliance share is worthing rupees somewhere around 2,400, something like that. Or we can say that it is something. I'm not saying it is a correct rate. For example, I'm just saying. Now I just give you an example how the mutual fund works. Of course, the nitty-gritties will be discussed in the respective chapters of every topic. Now the say Reliance share is say 2,500, and say Mr. A is having a 500 rupees. Now, if he wants to invest the Reliance share, money in the Reliance share, of course, fractional share is not allowed. Okay. So ultimately, one share he cannot buy it because the money is only with 500. Of course, at the maximum, what he can buy, he can buy only 1/5 of the Reliance share. So what happens? He want to invest, but he cannot invest. So what happens? Similar to A, there may be B, similarly E and J. All are having 500. Okay. So what they do, they pull up their money and buy one share of Reliance. Okay. Once they buy the share, what they do, they issue 1 unit of each. Value of 1 unit, that is called net asset value, is equal to 500 rupees. Now suppose after a certain period, the price of this share has gone to 3,020. In between, they have incurred 20 rupee expenses. So ultimately, net asset is with them is the share value is ultimately what is 3,000. One share. Now what they do? They sell the share in the market and divide the money among them. So 600 they are get, each one is will get. So ultimately for each unit. Now, how much they have invested in each unit? 500. Now they are getting back 600. So ultimately 100 rupee gain. So this is a concept of mutual fund. This is a concept of a mutual fund. So all this type will be discussed will be in the respective chapters. This is a because here we shall discuss meaning, evaluation, types, and advantage. So even some computation of like NAV, yield, all that has been covered here. Now, this is a very important topic, derivative analysis and valuation. Student, in derivative analysis, what is, when we say about the derivative, what is derivative mean? Derivative means deriving the something value. Okay, so for each derivative, there may be some underlying. For each derivative, financial derivative, there is something underlying. So underlying can be forex, foreign exchange. It can be your interest rate risk, interest rate. Normally here we use the benchmark rates like LIBOR, MIBOR, SOFR, SONIA, Astor. Okay. It can be your commodity. It can be it index like Nifty. Although it is a number, all say forex you can see, you can visualize it. Interest rate, of course, it is a non-visible, but it is something value have. Commodity you can see and what touch and everything. But regarding index, it is only a number. But still, it is normally used as a derivative instrument. So we shall see how we even index can be used to hedge our portfolio. This is all has been discussed in this topic. So derivative means driving its value. So here the various strategies like forward, futures, option, swap, and all this has been covered in the respective chapters. Now I'm not going in that much of detailing here because it will take a long time. Now, what is the purpose of derivatives? Derivatives, as I told you in the beginning, because don't indulge yourself in a this is derivative activities, because derivative can be used both ways. It can be used for the hedging purpose as well as it can be used for the speculation purpose. That is making the short, quick profit. But we shall normally in our study material, we have more insistence has been given on the hedging aspect of the derivative, because hedging, because derivative normally used for hedging. And once here, although in this chapter, in this derivative analysis, and our underlying is mainly one thing I forgot, main thing I forgot, index, even stock or share of a company. One important point I forgot. Here in this derivative, normally we have covered index. Three things we have covered here in this topic, but in next two topics, our underlying will be forex and interest rate risk. So here the basic concept of the derivative has been covered. Of course, the basic concept will remain the same. Forward, future, options, all things will be the same. Only there will be a change in the underlying. In this chapter, we are underlying is stock price or the index. In the next two chapter, our underlying will be forex and interest rate. So that we see, so this has been covered here. So here, even we have in derivatives, we have discussed, there is a concept of valuation of derivatives. There is, so here the valuation of option, valuation of forward, future, and another is Black School's model. Option pricing model has also been covered. So all these nitty-gritties has been covered in this chapter. Now, student, next topic is the foreign exchange exposure and risk management. It is one of the very important chapter from the practical as well as from examination point of view, because nowadays the world has become global. Days are gone when before, say, the main revolution, I will say, has come into 1991. Before, I think somewhere because LRM liberalized, LRMS scheme has also been come into 1993, and somewhere around there was one system before 1993. Normally there were some foreign exchange rates, because what is foreign exchange rate means, because every country has their own geographical boundaries and they have their own currencies. So once if you are trading or we are doing the trading within one own country geographical boundaries, of course the same currency will operate. Like in India, whether you go to Odisha, whether you go to the Bengal, whether you go to the Gujarat, whether you go to Jammu, Kashmir, whether you go to the Tamil Nadu, whether you go to the Manipur, wherever you go, east, west, north, south, wherever you go, the rupee is the currency used. Okay. Now, once you cross the border of this India, of course, rupee will not be acceptable there. They have their own currencies. However, what happens once the countries trade with each other? So they normally what happens? They don't accept their each other currencies. They use the one common currency that is called trading currency or reserve currency. And nowadays there are 5 currencies are there somewhere. On the top is US dollar, euro, pound, Japanese yen, and Chinese RMB has come. So these are some currencies which are normally used for the frequently. US dollar, of course, on the top. So every country says, you give me the money in US dollar, because dollar is used as an international currency, common currency. Because each country, because for example, if we are exporting the goods to any say Bangladesh, or we can say we are exporting the goods to Australia. So from Australia, we shall expect the dollar payment. Why? Because if we are importing the goods from China, they won't expect the payment from us in Indian rupee. They will ask the payment for any international currency. Of course, we shall use the dollar that we have received from the Australia. So all these have been covered. But what problems happens with this foreign exchange? It is a volatile, because before 1993 in our India, the foreign exchange rates are predefined because they are normally defined by the RBI, and normally all transactions are used to take place at that. After 1993, all the rates are now market driven. These rates are now market driven. So when these rates are market driven, what happens? They are exposed to risk. They are exposed to risk. They are market driven, and ultimately what happens? Because demand and supply, it is a play of the demand and supply. It is a play of demand and supply. So here it comes how we manage this risk, because there is a risk. For how it is a risky, just I give you a very small example. Suppose any company has exported, say, goods of the $1 lakh to another country. At this, and payment is expected in US dollar. Now today, $1 is equal to say rupees 80. Of course, and now this topic is also related to your accounting standard relating to foreign exchange. You can have a idea where, because there we consider the translation risk, translation accounting, hedge accounting, you can say. Now tomorrow, by the time the payment comes, it can be possible that the dollar may become weak and it becomes rupees 78 $1. Now here there will be a straightforward loss of rupees 2 lakh to the exporter. So here we shall discuss how we can secure ourselves. Accordingly, 3 exposure are there. Transaction, that I have covered here. Translation, that is normally you can say it is a kind of accounting risk, because once we compile the balance sheet, or once we, because our function reporting currency is Indian rupee. So once we report any Indian company their balance sheet, they have to report in Indian rupees. At that time, if they are holding any asset in foreign currency, it has to be converted. So of course, this value will keep on changing. That is called translation exposure. Then another is economic exposure. Economic exposure means, because due to economic reasons, there can be you can say that there can be a change in the demand and supply of the goods. How it happens? Suppose if China has revalued their currency, they have revalued their currency, and ultimately it has become stronger. So ultimately, what will happen? The demand for Indian goods will be increased. Demand for the Indian, because they will become cheaper. So although it is a gain for us, but still exposure means risk, deviation from the earlier one. So all this has been covered here. Now, next concept is international financial management. Now, student, you have discussed this topic in the your intermediate level. Here, we will see its international aspect that I discussed with in the beginning. That one or two topics that you need to of FM you need to thorough here, because in your intermediate paper, in intermediate paper, we have covered capital busting. That was basically domestic capital busting. You are investing the money in India. Okay, your inflow is in Indian rupees. Of course, your investment is in Indian rupees, and your inflow is also is Indian rupees. So this is called domestic capital busting. Here, you are not investing in India; you are investing outside India. Now, when you invest outside India, what happens? You are exposed to foreign exchange risk. You are exposed to forex risks. Now here it comes question rises how you are, because you are investing the outside India, so you are exposed to, because forex will be volatile. Forex will be volatile. So here we shall discuss how we can analyze our capital busting this year in the international context. Okay, so whether we should accept the project. Of course, the concept will be same, NPV, etc. will be same, but here our view, or we can say our vision, will be international. Similarly, there are multinational cash management, multinational receivable management, and multinational. Normally, theoretical topic portion has been covered for these two. Only some numerical has been covered in discussion in this topic on multinational cash management. What is multinational cash management? Because see what happens. This multinational cash management is important in case of MNCs, because MNCs have their branches worldwide. Now here we shall see this called technique netting, and say Pepsi may have a MNC in India, they have a subsidiary in Sri Lanka, they have a subsidiary in Bangladesh. Now suppose I just give you a small example. Suppose if I have to transfer the money from Sri Lanka from India to Sri Lanka, and Bangladesh has to give me the Bangladesh subsidiary has to make me the payment. Now there is a procedure that I pay to my Sri Lankan subsidiary, and Bangladesh subsidiary pays to me. Instead of that, what we do, we can do the multilateral netting. There is some multilateral netting concept we shall cover here in the study material. We can do the multilateral netting, that I will ultimately pay the net amount. I will pay ultimately the net amount. Suppose if I have to pay $1,000 and Bangladesh has to pay me the $800, and one line I forget. And suppose Sri Lanka has to pay Bangladesh $800. So ultimately, instead of that, this money rotated. I just give you one presentation mode. Say it will be better if now say it is India subsidiary. Oh, sorry. Say here, this is Indian subsidiary, this is Bangladesh subsidiary, this is Sri Lanka subsidiary. Now suppose Indian subsidiary has to pay $1,000 to Sri Lanka subsidiary. Sri Lankan subsidiary has to pay $800 to Bangladesh, and Bangladesh has to pay Indian subsidiary $800. Now you see, instead of these three transactions, because here the exchange rate loss will be there, what happens? What they do, we set off the amount. How we set off the amount? We say I am paying. Now you see there are three transactions. Instead of that, what can I do? I can pay straightforward $200 to Sri Lanka. So all these extra two transactions are eliminated. All these transactions are eliminated. So it is called netting of concept. That is called netting of concept. Now, next concept comes the interest rate risk management. As I told you in the beginning, this is a main, there's a concept of the main cause of failure of SVB bank was interest rate risk. So here we shall discuss how we can hedge our interest rate risk, because normally banks, here there is one important concept you need to understand better. There are two concepts. One is fixed interest rate. Another is floating interest rate. Because of this floating interest rate, this, of course, because of fixed rate also, both because of these two rates, the interest rate risk exists. Because suppose if and here how we can hedge our risk. Suppose I'm just giving you a very small example. Today, say a bank borrows money at bank, not a investor, a company borrows the money from a bank at floating rate, some benchmark rate. So benchmark rate here is, say, you can say 10%, not 10%. You say whatever benchmark rate is X benchmark, and today the benchmark rate is 10%. We cannot say this is quite high. We can. I just give you one more example. There is a concept of basis point. Here you will need to understand what is a basis point. This is a concept of basis point, because interest normally quoted like that, BPs. It is a 100 times of the interest rate. So say 1 basis point is equal to 0.1. Okay, 0.1. So 50 basis point means 0.5%. Okay, so normally whenever we quote the loan, etc., we say benchmark rate plus basis points. Say benchmark rate is MIBOR, is today is 6%, and we quote to the 500 basis points. So ultimately we say that the rate of interest is today's, we are giving the loan to the bank, say any company, bank is giving the loan to a company at 11%. Now tomorrow it may be possible that this benchmark rate may be increased. Here there will be a loss to the company. So now in this chapter we shall discuss how they can hedge. Here there are traditional techniques and as well as modern techniques. So all this has been covered here. In modern techniques, normally we covered the derivatives. In this we covered the derivatives. So all this has been covered here. Job is asking, sir, netting of centralized cash management. Yeah, it is a centralized cash management. You can say it is a centralized cash management. Namarta survey 11%. Yes, better 11% means 6% plus 5. How much I quoted here? 6% plus 5%. Very good. Now here in the corporate valuation chapter, we shall cover the topic of how we can value the various companies. Here we shall discuss the concept of, because in our topic of security valuation, there the securities are there. But when we talk about the strategic, one of the strategic decision is that I will cover in the next chapter, that is merger acquisition and corporate restructuring. But now question rises, how much price I can pay for any company? So this is called corporate valuation. So here we should discuss normally what is corporate valuation. There are some different techniques. And here we have covered the concept of like economic value added, market value added. So all these concepts have been covered here. Even we have taken one or two new methods like chop shop method. So all these methods have been covered here to value any company. Next concept comes merger acquisition and corporate restructuring. Student, you can say it is one of the very strategic type of decision. So even if you start reading the newspaper, I think hardly any week goes where there is any no news of any merger acquisition. So nowadays the companies are acquired, very quickly, and there is a spate, we can say, and especially in some earlier years, there was a spate of acquisitions. In India, we can say that one of the very leading case, the spate of acquisition has been started with the Tata Chorus deal. Somewhere around in 2007, it has come into the limelight because Arcelor Mittal was also a deal. Mittal has acquired the Arcelor group of the. So after that, we can say uh, there is a competition of acquiring the companies. Now here we are discussing the what is the, because when we acquire any company, some various aspects are involved, like due diligence, law aspect, regulatory aspect, and financial aspect. So here our insistence is on the financial framework. We are not going into the nitty-gritties what the law says. We says if the one company is acquiring another, or the two companies are merging together and becoming new company. So what will be the value of this company and how we will value this company, that will be covered in the corporate valuation, and how the settlement of this purchase consideration will be made, whether this will be beneficial for the shareholders or not. All this financial analysis is covered here. So here we normally there is one important term, beta, divestitures. Here it is always not that the value enhancement of can be made when we acquire the company. Sometimes we can spin off. We can spin off the company also. Recently, I think there was one news that a company has spin off. In fact, it was an article in the meant that in America, due to this federal crisis, one company has spin off they don't want to bring out their IPO. What they have done, they have spin off their one unit, one is split off, spin off, okay, carve out. So all these concepts have been covered here. In a spin off, what they have done, they have made a separate company and they have invited the money for the they are becoming with the IPO, etc. So all these concepts have been covered here. So it is not always that merger acquisition means acquiring another company. Divestiture means we are selling a part of the company. It can be possible that the companies can be divided. Company can be divided. I think somewhere around in 2 years back, their mother Sumi Motherson, there was something split off like also there. Not Mother Sumi San. I don't recall, but there was some 2 cases also I have studied where the companies have been split to maximize the wealth of the shareholders. Job Koni, synergy benefit. Yeah, Sun Pharma Limited and Ranbaxy. Yeah, you can say that. For synergy benefit, I can actually divestitures normally not taken for the synergy benefit, because synergy for benefit, one of the very important concept of the synergy benefit is that they say that if 1 plus 1, it is always say that it is 2, but synergy says 1 plus 1 is greater than 2. So when 2 companies are combining together or 3 companies are combining, so here synergy plays a role. Merger acquisition, normally synergy plays a role. For you can say in case of a split off, normally the split off or spin off are normally carried out when a company wants to concentrate on their core activity. Sometimes one happen, a company may have their own core business, but out of say some time they have invested some in another business and it is going on well, but because company ultimately management is the same, so since they could not devote their complete time to their core business, they may say, yeah, okay, let's spin off this unit, let's spin off this business or sell it, or we want to get the right of the same, because we want to consider. So that there the normally consideration is this synergy benefit we cannot exactly say, because synergy benefit normally comes into the picture in merger acquisition. Then there is ownership restructuring. Ownership restructuring means that is internal reconstruction, that they change the liability and structure of the share. Then there is a cross-border acquisition. There is a cross-border Acquisition. Cross-border acquisition means where companies are acquired from outside companies are acquired. Now, this is the last topic of your syllabus, that is startups. Now, student, I need not to tell you about the startup because nowadays even a small children are also very well versed with this concept, because days are the gone when we were used to teach in our school days companies concept, sole proprietor concept. Now the everyone talks about the startup because now they are startup founders of the startups are the heroes. Okay, so they have become the heroes nowadays. What is a startup? Startup means you can say it is a totally new idea. It is not an established idea. So here in the startup finance, because startup finance is totally different. Because what happens in our traditional companies, traditional organizational structure, we used to have a sole proprietorship, then it is rising to partnership, then from partnership to our company, then IPO, all this long journey is there. But now in startup, what is happening? The money is flowing like nothing. The money is pumping like nothing. By the investors, they are pumping in the new idea. So here, the you can say the dynamism of the this financing startup is totally different. So here we have discussed what are the different sources of startup funding in the science round, and we have also covered the Startup India initiative because government is also promoting this round. So with the student, I am taking a small break. After that, I will briefly discuss with you about the this first topic, financial policy and corporate strategy, and I will also cover two questions on AFR. This is your external funding requirement. Two questions I of the assignment will be discussed. Rest of the questions are covered in the in my recorded next lecture. So, student, we are here. I am just leaving. Giving just taking a small break here for 10 minutes. After that, I will join you. Ashok ji, अशोक जी, हाँ ब्रेक ब्रेक लेना है मेरे को. ओके ओके स्टूडेंट, सी यू आफ्टर 10 minutes. Welcome back, friends. Now, here I am discussing with you the first topic. So, students, this is a basically in brief in the beginning in this chapter. There is a brief description of various strategy that has been covered here. What is basically what we mean by the strategy, and what is because here we have to see, we have to create a risk return trade-off kind of a thing, that we have to make out some balancing something. So all this has been covered here. Then we have covered all this. All this has been covered in study material. So please, student, note that whatever I have prepared this slide from this study material, and if possible, I will share this slide with you. So these are contents will be shared with you. Function. Now we come to the functions of the strategic financial management. Strategic financial management is a portfolio constituent of the corporate strategic planning that embraces the optimum investment, that covers the optimum investment and financing decision, and required to detail this. So ultimately, this is the objective that has been covered in the FM also. Irrespective of the time horizon, the investment and financial decision will allow the continuing the research, selection of best possible investment opportunities, determination of optimal mix of funds, that is capital structure. Okay, establishment of the system of the internal control, and analysis of the result of the future decision making. So all are covered here. So you can go through them. There is nothing. Now it is the key decisions that are the within the scope of the financial strategy: financing decision, investment decision, and dividend decision, and portfolio decisions. Now, of course, these three decisions you have discussed. We have discussed about intermediate. Portfolio decisions is covered in this SFM chapter. Namarta is there. Please share these notes. Okay, Namarta, what I will do, I will share the notes. Don't worry. I will share the slides with you, considering the any copyright issue. Don't worry, I will share. But student, for the remaining topics, normally we don't share any slides because they are numerical based, and we expect you to prepare your own notes from the, because in slides normally we can give any brief description. So all has been covered in your study material, but of course, if possible, we shall give you the notes. Now, there are three levels of strategies. One is corporate level, business unit level, and functional level. Now, student, what is corporate level? Now, corporate level, what happens? You can say it is a mission of any company. It is a mission of any company. So it is a broad company. In this business unit level, here we cover the business unit level. Business unit level, because a company may have different businesses. A company may have a different businesses. So ultimately, the corporate mission is achieved by this business level. For example, Reliance may have a different divisions. Reliance Industries Limited may have textile. Okay, they have many divisions they have. I just give you a small example. Just 1 minute, 1 second. They have a textile, fabric, yarn, and variety of petrochemical products. So they have a different business units, and in this business, so ultimately the objective of the mission of the Reliance Industries Limited is a corporate level strategy and how they meet through the different business units. Now next comes the functional level. Student, all you think say you are well versed because the concept of strategic management has been covered at intermediate level. I'm just giving you a brief. And there is one query of job. What is the spin-off job? Just have some patience. I will discuss with you before I start the next topic. Job is FMS is I not clear about your query. Just send it again. But I will clear your spin-off query. Next is come the functional level. In a company, there can be different functions like marketing, finance. Okay, marketing, finance, HR, production. Normally we are covered with the we are concerned with the finance. In a finance, there can be different taxation, audit, accounts, payroll accounting, and you can say payroll accounting and budgeting for budgeting. So there can be different, in a functional, there can be different divisions. So all are, this is a kind of a hierarchy, we can say. Now here just a briefing like that, corporate level, whether the strategy will be would work for the accomplishment of the, so it is decided by the corporate level. Determine the kind and the number of resources. It is very important because it is a corporate level that we normally raise the funds. Company decides how much we will require the funds. Suppose if Reliance comes out with any new venture, so of course they have to decide how we shall raise the funds from the market, or whether what are the various resources. It is concerned with the stakeholders' satisfaction. It is very important. Overall objective is the stakeholder satisfaction. The stakeholder, be it be the shareholders, be it be the public, be it be the government. Stakeholders does not mean always that it is a shareholders. It can be anyone. Like for ICI, stakeholders are like members, students, council, all these are stakeholders. Council, of course, council is you can say report. You can say sees the satisfaction of the members as well as students and even society, government, because it is a regulator. So we can say the stakeholders are student, members, government, society. All these are stakeholders. Now in business unit level, studies detailed actions are taken to provide value to the customers and gain a competitive advantage. Here the competition decide. We have to capture the market share. Here it is there concerned. It is concerned with the firm's position in industry. As business unit level, the strategy issues are about practical coordination of the operating units and developing, sustaining a competitive advantage. Here again the word of sustaining has come. Of course, sustaining means continuous. It will be continued. Now next comes the functional level strategy. Now functional level strategy means R&D capability. All these have been covered here. Okay, student. So I need not to discuss again and again because all you are well versed. Here just a brief description. Strategic means long-term course of action. Who decided? Senior management decided. Tactical means intermediate planning. Middle level, we can say it is a kind of a business level. And last is your level of strategies, short-term and operational looked after by. So these are basically, you can say, kind of a strategic, how at what is the basic of the levels of the strategies. Now, next topic becomes is a financial planning. Financial planning is the backbone of the business planning and corporate planning. Financial planning is a systematic approach where the financial planner helps the customer to maximize his existing financial resources by utilizing tools to achieve his financial goals. There are three major components: financial resources, financial tools, and financial goals. Okay, student. Now, next, I am discussing with you the concept of external funding requirement. Though, student, it has not been directly covered in your study material. But here I want to discuss with you because I think in January 2021, there is one question that I have also covered. The question has come into examination that I thought I should discuss with concept with you. Now, what is external funding requirement? External funding requirement is an important element of financial planning and also forms the basis of budgeting initiative. Also required for estimating future financing requirement. Now, what are the steps are involved in financial for external funding requirement? First, forecasting the firm's sale as it is a for other forecast budget followed. Student, please note that if you recall that whenever we carry out the budgeting exercise, It is a sales that forms the basis of other exercise. Making projections of other variables such as expenses. Okay. Estimation of the level of investment in the current and fixed asset to support the project. Because whenever there is any growth, how the growth shall take place, unless and until there is an increase in your capital in the form of working capital as well as fixed capital. Fixed means non-current assets. So unless and until there will be increase in this, you cannot maintain the growth. Sir, for this theory chapter, okay, student, I will try to share the notes if possible, because ultimately your theory is basically reproduction of your study material. We will try, if possible, we will try to upload the notes. Don't worry. Then determining the financing need. Okay, student. So there can be a possibility, like assuming that following a 12% increase in sale, 6%. So by this permutation and combination, we can determine how much extra fund will be required. Now there are basically two methods. One is percentage of sales method. Another is computing the exercise formula base. First, we discuss the analytical approach. Okay, how we analyze it is basically very, you can say it is a back of envelope calculation. Just simple, we carry out the analysis. Okay, this will be the increase, this will be the increase, that's all. Okay. Next is formula. This is a formula approach. Student, please note down this formula. This is external funding requirement. Here, what is it? Is basically total assets to sales ratio. Basically, we use the historical ratios. Okay, so all these ratios are historical. This is also historical ratio. So because we estimate that in the coming year, our sale will be increased by this, then how much funding, external funding will be required by us. All this are can be also computed by this. So just note down this formula, because when I will in a few minutes I will discuss with you the solution of the some two assignment question, then this formula will also be covered. Here this is asset oblique sales, this is change in sales, this is liability, and this is a profit margin ratio. Okay, because S1 is our projected sales, this is projected sales, next year sale, and this is dividend in the percentage of payout. This is a dividend payout. Okay, student. So if we use this formula, we can directly compute the external funding requirement. Student, here it is very important to note that if nothing has been mentioned, so it is always means total assets means it is always assumed that it is include both fixed or non-current or plus current assets. Okay, student. So let us see how we can we shall. I'm just discussing with you the question number 1. Student, the question that is shared with you in assignment, it may have 1 or 2 error, like dividend spelling has been misprinted, but don't worry, in a we shall host the correct assignment after this class. So but you can refer this question. Here the balance sheet has been given to you. Okay, the total is 60 lakh, 60 lakh. Now this is the income statement has been given to you also in the question. This is a sales, this is the cost of goods sold, gross profit, indirect expenses, EBIT less interest, EBIT, and this all has been given to you. Okay, this is a tax rate has been given to you. Now it says, sorry, it has been again. Assuming that the next year there will be an increase in the sale by 15%, then what would be the first? What will be the modified income statement? So it is the prerequisite. It is a prerequisite to compute the external funding requirement. Okay, what will be the our modified income statement? Then we have to compute the external funding requirement. Just read the slide. Now, if the increase by, if change in the total asset in the proportion of sales and no dividend is declared, change in total assets in a proportion of sales and not change in total asset in proportion of sales and 50% of dividend is declared. Okay, student, I think in the assignment, just you refer here. There is different scenarios. Please refer from the exam. This is from your module. In a first case, here you just add no change in fixed assets. Just refer the assignment question, then I discuss with you. अशोक जी, मैं उस पर स्विच ऑफ कर रहा हूँ. Student, we are taking a break of the 2 minutes only, so that Okay, student. Now here the question of the assignment I am taking with you. So I hope the question is visible to you. In case if you have any issue, just send us the message. Now, student, this is a balance sheet. Okay, as I have shown in the my PPT slide. Now, this is a income statement of the year 2021. Now, assuming that the next year there will be an increase in 15%, then what would be the modified income statement that I told you that is a prerequisite, and then the revised balance sheet of ABC Limited and analyzes the external funding requirement under following this sales. Okay. Now, scenario one, no change in fixed asset in proportion to sales and no dividend is declared. Scenario two, change in total assets means working as well as current and non-current assets are changed in power and no dividend is declared. And last, total assets plus 50% of dividend. So here some portion is there, no problem. I'm just discussing with you the solution. Now, student, the solution, first of all, we have to draw out the modified income statement. Now, first, we shall here write the sales. So there is an increase of 15%. Less cost of goods sold. It is in same proportion. Okay, Namrata, I may not be visible. I may be very small visible. Don't worry about the same. But screen is visible to you. My concern is that solution should be visible to you. Okay, so this will be our gross profit. Indirect expenses. Okay, student. So this will be our EBIT. True. Less interest. Assuming that it is same. No change. So this will be earning before tax. Our tax rate is 42%. Till now, student, if you find any calculation error, please just let me know. Okay, student. I hope till here you don't have any problem. Now, student, I am preparing the balance sheet of scenario 1. Now, student, first of all, we are assuming there will be no change in fixed assets. So it will come student, this is Vikalp. No, it is not in the study module, but here we are discussing the same. Fixed assets. Now current assets will be increased by 15% up, because it is always, that's why it is called the spontaneous. Okay, students, now come to the, let us see, we come to the liability side. Equities remain the same. Now retained earning means this amount, because there is no dividend. Here, long-term debt. This is more important. Now this will be the balancing figure. I am not writing it now. I shall compute it. Or you will compute it. You will let me know. Accounts payable, again 15% increase. Why current liabilities is said as spontaneous source? Because normally it increase in the same proportion of the sale. Now, student, please let me know the figure of what is the balancing figure. I am awaiting your answer. Student, please compute this balancing figure. Uh, 28. No, beta. Just try it again. Let me try again on the calculator. Very good. Namarta, very good. You have got the correct value. 1,11,595. So here it is a balancing figure. It means our long-term debt is 1,11,000. Now here question arises, what is external funding requirement? Earlier our amount was 13,30,000. Here the amount is 11 lakh. So it means it is minus 12 lakh 18,405. Now alternatively, this value can also be computed using the formula approach. Now let us see how we can compute it. One second, I think student there may be some problem. 1 minute. 1 second. One second, students. One second. Is the screen visible, students? Namarta, beta, it is the previous year balance sheet. 30 lakh 13,000 is, you see the assignment, it is the previous debt. So we can say it is a change in asset minus change in liabilities Student, please note the change in asset is 5,31,000 because if we compute the 15% increase of the same, it will be 5,31,000. Just you add this, okay, and compute the 15% of the same. The value will be 5,31,000. Minus change in liabilities. Again, come here. Add up this amount. Okay, and 15% will be 25,500. Okay, straightforward. I am taking the profit from here since dividend is 0. Accordingly, our answer is okay. So external funding requirement is existing debt Okay, thank you. Okay, student. Now we are discussing the scenario 2. First, our modified income statement will remain the same. We are just I'm considering only the balance sheet. Now, in this scenario, there will be an increase in the total assets. So our fixed asset as well as current assets will be increased by 15%. Okay, student, the total will be 69 lakh. Alternatively, you can see that here the total is 16 lakh, 15% is overall asset increase. So 9% increase will be there. 9 lakh, 9 lakh percent, 9 lakh will be addition will be there. Again, we do like that. We equity. Retained earning. Okay. Now long term debt. Again, balancing figure that you will tell to me. Current liabilities increase 15%. Now, student, please calculate the figure and please let me know the figure of closing debt. This is long-term debt balancing figure. Namarta beta, because in this scenario we have assumed that all assets will be increased, so that's why we have taken the increase in fixed assets. Moreover, even nothing has been mentioned in any scenario, nothing special scenario has been given. It is always that assume that with the increase, our historical assets are also increased in the same proportion. Now please compute the figure. Meanwhile, I'll also carry out my own calculation. I'm awaiting your answer. One second. I think maybe my mistake may be there. We have what back. 1,43,71. 1 second. 69 lakh minus 45 lakh minus 1723 905 minus 143 750 51 750. Now, student, what is yeah, very good. I think Namarta, you are nearby. It is 418,595. I think there may be some. Dhritman Bhaumik has given the correct answer. And Namarta, you are nearby. I think there was some calculation error. I think 90 rupees difference is there. Very good, Bhaumik. Dhritman. Okay, student. So now we compute what is EFR. Here, our previous debt was 13,30,000 minus 4,80,595. So EFR is minus this. Okay, now we can also get it by formula also, but here I will like to pinpoint the difference. Here our EFR was in case scenario for 12 lakh 18,405. Here it is 8 lakh 14. If I see the difference, so what is the difference? 3,69,000, and this difference is on account that my assets has been increased by fixed assets has also been increased by the same amount. Okay, I'm just giving the logic. Okay, no problem. You will note it down, then you will get understand. Okay, now I'm coming to formula approach. Okay, now if I see the formula, here ultimately what is the increase? 9 lakh. Okay, so 9 lakh increase in assets minus a part is financed by current liabilities, that is this increase, as we have done in case of scenario 1, same. Minus earning so this comes amount minus 849,405. Accordingly, EFR existing debt not EFR is this, EFR is here, sorry. So our new value of debt is 4,80,000. So we can compute EFR by using the main purpose here, letting you know. Now, student, let us discuss the scenario 3. So now let us see net fixed assets Any student has any doubt? They can discuss it. Okay. Equity. Now here, student, please note, our scenario says 50% of the profit is declared as dividend. So ultimately, what will be the retained earning? The 50% of the same. 50% of the modified income statement, that is 50% of it is 8,61,953, rounding off just. Okay, students. So this figure will become as a retained earning in scenario 3. As usual, I will expect this answer from you. Okay. Now please tell me the answer. Sir, need to do both balance sheet approach and found. No. Any one approach. Any one approach you can follow the unless and until in the exam. Normally they don't ask you any formula approach, so you can follow any approach. No problem. This is applicable in maximum questions of SFM. You whatever only follow one, because when I will discuss with you the topic of bond valuation, you will also see that there are two approaches. One that has been covered in study material and another approach I am discussing with you. So you are free to attempt the question in the approach whatever way you like. Only one approach. Don't give the. Now just get me the answer better. I am waiting for your answer. Very good. 13 lakh. Namarta, very good this time. Correct answer. Even Dhritiman got the correct answer. Mansha also got the correct answer. Very good, better. Keep it up. Okay, now student, let us see the formula approach. Like second scenario, increase is 9 lakh, increase in current liabilities minus. Now here in our scenario 2, our figure was this much retained earning because no dividend has been declared. Here we are declaring the dividend. So what we write? 7 lakh 23,905 into 1 minus 0.5. True. So the figure comes 1 second. Minus 8 lakh 64,000. Sorry, 8 lakh 61,953 equal to. So it is our external funding requirement. So now see here, student. I forgot one step. Here it is your 13 lakh 42,547. Here it is. So just if I follow the balance sheet approach, 547 minus 13 lakh 30,000. I just forgot this step, but I'm just repeating here. Same value. I'm getting here. Okay, student. So I hope with this you have this question must be clear to you. I'm coming to the next question. Student, a part of this question is has been mistakenly come. So I'm just reading this question, then I will solve this question with you. This question is from your study. There's a January 2021 attempt. The question says the balance sheet of MS Sundry Limited as on 31st March 2020 is as follows. Now, student, before I start this question, I want to discuss with you one or two things. Till now, and we have assumed that everything will be spontaneous or whatever increases them. But sometimes in these three scenarios, we have seen that they want to increase the sale. So if the sale is increasing, our assets is also increasing and liabilities are also increasing. So balance amount is we are getting from the from balance amount we can get an idea what will be our external funding requirement. But sometimes there are some constraints, like the management say that our debt equity ratio should not be spoiled. Okay, they may have some apprehension, they may have some so in that case, how we use the computation, how we drive the computation, it is in this question we shall see. Normally in this type of questions, we use the simple analytical approach, that is biological. Okay, of course formula can be there, but formula normally does not use, we cannot directly use the formula. This is that we have used in previous this question. Here we shall use the formula of like assuming X. Let us see this question, then the concept will be more clear to you. Now the balance sheet of MS Sundry Limited as on this shows as follows. This is the balances. Now I am continuing the next question. This is assignment, same question assignment. Okay, student. So balance sheet total is 1400. Now sales for the year was 6. It was earlier year. Now here they are expecting that it is expected to grow at 20% during the year. The profit and margin ratio, the profit ratio is this, and 50% is expected as a dividend. Now, if we have been provided up to this figure, then there will be no problem for computing the external funding requirement. But since these are additional rider, we have to see how we can compute it. Okay, it says the company further desires that during the current year, sales to short-term loan and payable provisions should be in the ratio of 4:3. They have given the condition that our ratio of sales versus short-term loans and payables and provisions should not violate this. Ratio of fixed assets to long-term loans should be 1.5. Okay. Equity debt equity ratio should not exceed 1.5. So keeping all these conditions, three conditions, we have to compute the external funding requirement. Now let us see the solution. First part is external funding requirement. Okay, these all figures are in lakhs. Expected sales 600 lakh plus 20% of the same. It comes 720. Now then we come profit margin. Profit margin is 4%. So simply we write it 28.280. Now here we are paying the dividend. So half of the same is this. Sorry. Okay. So balance is plow backed. Okay. Now how much additional fund we require? First of all, there will be an increase of 20. So we can say overall total balance sheet is 1400, or we can say total assets is 1400. Out of this 1400, payable and provisions are 200. So these will be increased proportionately. So a part of balance sheet 1400 minus 200, which is partly financed by working capital, you can say current liabilities, there will be increase of 20%. Okay, student, I hope it is clear to you, because see, I'm just putting insistence on this because our total assets is 1400. It increase will be 280. However, out of this provisions, payables and provisions, there will be no change in the here. Short-term loans cannot be, we can assume this change on spontaneously normally because they are as per the negotiation, whereas payable and provisions are during the course of trade. So that's why they are called spontaneous. Of course, sometimes assumption can be made, but precisely the payable and provisions are assumed to be on a proportion of sales. So here 200 into 20% minus 240. So it comes 40, it comes 240. Okay, students. So overall, we shall require the funds of 240. So our external requirement will be 225.60. Okay. Anyway, I can also calculate is the alternatively we can also be calculated with the formula. Okay, here our asset increases. Profit on new sale. So here we can also compute the using the formula. Okay, so no, not able to read it. But what item you are not able to read it? What you wrote their balance is. Okay, I think you are maybe talking about this figure, beta. I hope this is what you're talking about. See, beta, here 1400 increased by 20%, so it comes 280, and payable provision is 200, so it will increase proportionately. That comes 40, because it will be financed. 280 will be partially financed by this payable provision by amount of 40. So balance that fund will be required 240. I hope it is clear to you. Okay, Namarta, because beta, we have taken 1400 minus 200 because increase of the balance sheet, a part of total asset is financed by 200 payable and provisions. That's why we have taken it. That's why we are doing here 1400 minus this. We excluded payable and provision just because it is a current. Yes, of course, beta. It is a current liabilities. Normally, it is spontaneously increase. That's why normally we exclude it, because we required for the balance amount. There is a concept of net working capital. What does net working capital means? A part of current asset is financed by the current liabilities. The balance is required for this. Okay, student. Now I'm coming to the how we shall raise the fund. Now I'm coming to the second part. Amount to be raised from different sources. With following conditions that need to be met. Sales to short-term loans and provisions. Here he has included in the short term. So it should be 4:3. Then ratio of fixed assets to long-term loans. It should be 1.5. That is, our long-term loans are 1, then fixed assets should be 1.5. Debt equity ratio should not exceed 1.5. Okay, now let us see how we raise the funds. Amount of short-term funds to be raised. Funds to be from short-term sources. Or we can say how much short-term funds can be raised, both viable. Now here, student, please note, new amount of short-term loan. Short-term loans and payable and provisions. Because it says we have to maintain the ratio 4:3. Because if our sale is 4, then our this provision amount should be 3. Okay, accordingly, our new sale is 720. So amount should be this. So 5. This all figures in lakhs. Tushar is asking, sir, why it is not done in the current assets? See, but current assets is included in 1400. So it is already included. It has been increased because we have done the 1400. We have considered 1400. Here, if we go by the balance sheet, it is included in this. Okay, 540. Now less existing amount of short-term loan and payables. Short-term loan is 300 and payable and provisions 200 plus 20%, 240. So 540 will be increased. So requirement will be nil. Okay, students. So there will be no amount to be raised from short-term sources. So it will be nil. Now we coming to the amount to be raised from the long-term. Now here we shall see what is our new condition. Our new fixed assets are also increased proportionately. It comes 720, no problem. Now our new long-term loans should meet this condition. What is this condition? 1:5. 1.5 means whatever be the our fixed assets, it will be our long-term loans at the maximum can be 1.5%, 1.5 times of our long-term loans. So the maximum long-term loans can be 480. Less existing long-term loans. Okay, so this will be amount to be raised from long-term loans. Okay, now next is amount to be raised from equity. Amount to be raised from external resources means EFR 225 points as we have computed here. Less amount to be raised from short-term sources nil, less amount to be raised from long-term sources 80. So the balance will be from the equity. So from equity we shall raise this much of amount. Okay, student. And I hope this is clear to you. Now I am doing it by the alternative approach. First term long-term fund requirement. How short term? What amount we shall raise from the short terms? So let X be the new short-term loan. Accordingly, the condition given This is our sales. This is our current liabilities, and this is new. अब स्टॉप हो गया, एक मिनट रुक गया इसका ब्रॉडकास्ट. 1 second स्टूडेंट. रुक गया था. नहीं कर रहा हूँ. आया नहीं आई थिंक. अशोक जी, ये स्क्रीन शेयर मेरा नहीं आ रहा है. नहीं आ रहा. लेकिन होल्ड करो. स्टूडेंट वेट फॉर सम टाइम. आई थिंक ये कनेक्ट कर रहे हो दोबारा. स्टूडेंट प्लीज होल्ड फॉर सम टाइम. Vikalp, just 2 minutes. I take your query. Don't worry. Okay, visible. Okay, students. Now here, if we solve the x, 1 second. Echo. If we solve the x, the value comes 300. New short-term loan required 300 lakhs less existing यार ये क्या प्रॉब्लम आ रही है. वाईफाई का इशू आ रहा है. कनेक्ट कैसे कनेक्टिंग है देखो. Student, just hold on. There are some technical glitches. Students, here new term loan funding required is 300 and existing is 300, so there will be nil requirement. Now we are coming to second requirement, that is long term funds. Okay, let y be the new long term funds requirement. Now we have to meet the condition Fixed assets is 600. It will increase proportionately by 20%, and it is this. So our Y will be 480. New amount will be 480. Existing 400. So balance will be from the long-term funds. Next is equity to be raised. Okay, job, whatever approach suits you, you can follow. Less short term, nil. Long term, 80. Because this has been met by this, so balance will be 40 lakh. Now let us see whether our condition is met. New debt equity ratio, debt upon shareholders fund. Okay, this is our new equity, existing equity. Okay, and our last year profit was here our 600 lakh was there earlier profit, or we can see our 200. Okay, so here our point 70. 1 second. So our condition is met. One second, let me check the same. I just give you a complete 300. $400 is was this year 24. Okay. And 1 by has been given to declare. This is reserve figure, beta. It has also been increased. Or alternatively, you can also compute one second, beta. my 1 second. You can also determine what is the profit. Even you added the same, you will get the correct condition will be satisfied. Number the only one approach. Okay, student. With this, I hope the whatever is discussed in today's class must be clear to you. Of course, in the forthcoming session, there are recorded lectures are there, and after that, there will be one session by the CS Vivek Banerjee for the two topics: security analysis and security valuation. That is equity share will cover there. Meanwhile, if you have any query, you can send us at email at sfm-final@ici.in. It is in lowercase. I'm just writing here because it is visible to all. Okay, or you can contact us as 0120 this is our action. This is a STD code, and this is our my direct line number of our department, the SFM paper. So thanks a lot for students for patience listening. 1 minute. I think Vikalp has asked in suggested answer. We have taken the figure. 1 minute, 1 second, better. 450. Yes, let me come to here this point also. You are right. Here we have taken the $450. I think 200. 450. You may be talking about short-term loans and payables. Of course, 1.2% increase. Let me check suggested answer, but I think your observation is correct. 450. Oh, you are talking about the loan, new short-term loan and payables. Better let me check, and if it will be possible, you contact me over the telephone. Okay, not today because today I am going to meeting. On Monday you can give me a call, then I will discuss with you. But anyhow, this may be based on the assumption that the short-term loan will also increase proportionately. So I cannot comment right now because 450 figure appears to me somewhere odd. Okay, student. Thanks a lot. Have a nice day and continue to refer our lecture and be in touch with us. Of course, you will come out with a flying colors once your result will be declared. Okay, student. Have a nice day once again. Thank you.